Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates coming to you at 9 a.m. Eastern every Monday morning. Get you ready for the week, what to watch in the news, the stocks that could highlight the week. Could be a big week. Last week's inflection turning point in the market could mean a relief rally starting this week, so we want to get into that right away. Does Friday's rebound mean a relief rally or even the end of that 2022 stock market crash? Or is it just beginning? So we're going to look at the reasons we could see higher stocks over the summer, as well as some of the factors pushing stocks higher and pulling them lower. Stick around though. After that, we're going to get into all the highlights, the what to watch for the week, stocks that could define the week again, and stock news that you need to know. Before we get into that, if you do want to see the stocks I'm buying no matter what the economy or the market does, click on the link I'll leave in the description below. You'll be able to download that free report with the Motley Fool. They're going to send you some emails trying to get you to sign up for the Portfolio Advisor. I use the service. I like the service and the analysis, but it's totally free, no obligation to get that report, the largest stocks in my own portfolio. So again, just look for the link to that in the description below. Click through, you get that free report and help support the channel, so I appreciate it. But we want to get back to Friday's rally, what it means. Could it mean a relief rally over the summer for stocks and an end to that 2022 stock market crash so far, or how to invest in that? We did see that big rebound on Friday, and what was important, I thought, was really that it changed kind of the trend that we've been seeing over the last few weeks, where the investors sold out into the weekend. They didn't want to be long just in case some bad news came over the weekend, so they sold out, and Fridays have typically been very bad. But we saw that reverse on Friday. It's also come after some massive moves to the downside throughout the week, so maybe it could signal some kind of a capitulation in the market and an oversold condition for stocks. That capitulation is where investors sell out of everything. They just give up and leave, and that basically means all the sellers are gone and there's only buyers left. Now, of course, one day doesn't make a trend, so we will have to see how that develops over this week and next, but I did want to review some of the forces pushing stocks higher and as well as pulling them lower over these next few months. Stocks in the Nasdaq 100 did close for the 6th consecutive week last week, the longest bear run since November 2012. So a very bearish trend, very bearish run for the market. Investor sentiment, as measured by the American Association of Individual Investors, their sentiment index is at its lowest since March 2009. So basically, they survey investors and ask them, do you think stocks will be higher or lower over the next 6 months? And that index, more investors think stocks will be lower over the next 6 months than at any time since March 2009, the very low of that 2009 stock market crash. So that's typically a very bullish signal. When most investors are fearing the worst, that means things can only get better, right? On a valuation basis, in fact, the value of the forward PE ratio for stocks in the S&P 500, right? So the price to earnings ratio for stocks in the S&P 500 index is now at 16.6 times last week. That's below the 10-year average of 16.9 times. So it's the first time that's happened in quite a few years. Stocks are no longer expensive. They are now relatively cheap compared to that 10-year, that long-term average. So on top of the valuation here, the technical factors, the just a bearish sentiment by investors that could help support stocks, we also have an economy that is extremely supportive of stocks. Okay, consumer spending is still growing at about 6% on a year-over-year basis. Earnings from JP Morgan, the bank, a couple of weeks ago actually showed us that bank deposit accounts were increasing while consumers were also increasing their credit spending. All right, so they're putting more money in the bank. They still have that good cash to spend, and they're going back to their old ways of spending on credit cards and spending as much as they possibly can. So that's going to drive the economy, and unemployment remains at historic lows here. Wage growth is gaining momentum. So, and that's really the big one. You know, even if we do find employers start pulling back on the higher interest rates, fears of a recession, things like that, the job market is so strong that it's just really hard to see that turning down so much that it affects that consumer spending. Okay. You don't get a drop in consumer spending until people start losing their jobs, until people start fearing for their jobs. Not when unemployment is so low, not when there are more jobs available than jobless seekers, and not when wages are increasing. And why all this is important is because that would mean those lower earnings guidance that we've been seeing from companies that have really been destroying the stocks, right? A lot of stocks, a lot of companies coming out for the first quarter saying, hey, they beat their earnings, they beat their sales forecast in the first quarter, but they're really worried about the rest of the year, right? They're lowering their guidance on sales and earnings, and that's what's really disturbing the market, right? That lowered guidance, those lowered outlook for the rest of the year is destroying a lot of the stocks. Well, that means that management is probably just kind of playing that game of lower profit expectations, right? They want to come out the rest of the year, end up beating those expectations that they set, and justify their $1 million paychecks. So with the economy still in good shape, it's still very likely that they're going to be able to come out and beat those expectations, and that's going to be supportive of stocks through the summer and even into the fall. You know what we say though, it ain't all rainbows and unicorns either. I want to point out some factors that could be pulling stocks lower through this year, if not next year. And the big one here, of course, is just the Fed. The Federal Reserve is expected to increase interest rates throughout this year, throughout next year, even into 2024. This year, they're expected to take rates from zero, the Fed funds rates that they set from zero all the way up to 3%, which would be a huge move as far as that interest rate goes. It's already pushed mortgage interest rates very high, up to 5% and beyond. It's going to start pushing a lot of those other loans and costs of borrowing money up higher, and that does eventually tend to slow down the economy. Employers see that interest rate going up, the cost of borrowing going up, and they fear for a recession. They fear that they might have to lay off workers, so they kind of slow down that hiring. Inflation has also been persistently more than what we thought it would be, and could eventually eat away at that consumer sentiment. Now, the thing is, a lot of these, it seems that both of these worries have pretty much been baked into stocks, right? With a 20% down from the peaks on the S&P 500, with about 30% on the Nasdaq down from the peak last year. They may eventually weigh even harder on those indexes and on stocks, but it's really unlikely with that economic situation. And as we get into these second and third and fourth quarter earnings reports, where companies will likely beat expectations again for those earnings. What I'm worried about here is that it happens in 2023. So maybe we get a relief rally here over the summer, but then stocks do eventually turn back lower as we head closer into a recession next year. So how do you invest in this? Again, I do believe we get some kind of a relief rally here into the summer, maybe even as high as 10% more on the S&P 500 as the market kind of realizes those underlying economic factors that should be pushing stocks higher. I would be cautious though, as stocks are likely going to be volatile at least over the next year while the Fed is increasing interest rates. So we could still see a bigger sell-off into the end of this year and next year as the market does adjust to that likelihood of a recession later on. But again, here, I think we're in those oversold conditions for stocks. I think they're ripe for a rebound, and I think you take advantage of that. Now, I do want to turn it over to what to watch this week in the stock market, how to invest for that, the stocks that could highlight the week. We're going to start off with the stock sectors here. The big picture will be at the sectorspider.com here and the sector tracker. See what they did, see what the sectors did last week. Just one of the 11 stock sectors managed to close higher last week with that consumer staples sector, again, proving not only the safety in the crash, but that a lot of these companies, having already been hit last year on those inflation scares, are now coming out ahead of the rest of the market. You know, last year, a lot of these consumer staples companies, so think the packaged food companies, the personal products companies, a lot of them got hit hard as they saw inflation come through in their own costs, but they weren't able to pass those costs on to consumers. Consumers really weren't yet thinking about inflation, and they weren't going to take those higher prices. So consumer staples companies just didn't pass them along, and it really hit the profitability, and those stocks came down. Well, now they're able to pass those costs on because consumers they know inflation is coming, they know inflation is here, so they're accepting those costs a little bit better. So we are seeing those consumer staples companies do very well, and we've been talking about that on the channel for the last few weeks. There were still some sectors, some stocks in other sectors, though, even in the hardest hit consumer discretionary sector, that did really well, that were able to post strong gains, like a 6.6% jump. We'll just click here the consumer discretionary and show you Etsy e-commerce name. Etsy had a 6.6% jump last week. Shares of Match Group, online matchmaking site, rose 4.6%. And this really does show that investors are still willing to reward companies that can buck that trend of lower 2022 guidance and continue to report that growth. Now, if the idea of a relief rally is in the making, then it would be time to look at some of those sectors that got hit the hardest so far this year. So we're going to click through to the year to date to see how these stock sectors have performed so far this year. Obviously, energy is the big standout, the big winner in those higher oil prices. And we do see consumer staples and utility stocks have outperformed the rest of the market, only down slightly, about 0.5% in that. But what you want to do, you want to look at the stocks that have been hit the hardest. If we are in for that rebound, those are going to be the stocks and the sectors to rebound the best. So stocks in the consumer discretionary and communication services sector are down about 25 and 24% respectively as the biggest laggards. But though tech stocks aren't far behind, about 22% down year to date. Now, on a summer rally in stocks, the social media and streaming names. So if you click through here to communication services, you're going to see a lot of those. You're going to see a lot of the streaming companies, the social media companies, and media stocks are down big over the so far this year. We can change this to the biggest losers. So you've got Netflix, you've got the media companies like Dish Network, even Walt Disney, down 35, even 68% for Netflix. You've got some of the social media sites like Meta platforms, Facebook. You've got a lot of those, you've got Alphabet, a lot of the FANG names in there as well. Those would be the ones that I would be watching at in the consumer communication services sector, as well as entertainment related stocks. Live Nation Entertainment, ticker LYV, is down 24% so far this year, but reported really strong first quarter results that could continue to boost those shares. This is something we've been watching over the last few weeks. Very strong consumer spending in entertainment, travel, and leisure related stocks. That Live Nation booking higher ticket sales for their concerts. I think that's the one that continues to surprise higher, and that's one you should watch, that Live Nation Entertainment, ticker LYV. This week will be all about the consumer with the April retail sales report out on Wednesday. Housing data is scheduled out, and a lineup of earnings from really bellwether retailers like Walmart, Target, and Kohl's. So really that consumer spending, 2/3 of the economy, trying to gauge the strength in that consumer spending and see if it's really going to continue to support stocks and the economy. Now, last month's retail sales report did come in slightly lower than expectations, but not much. It was a slight dip from the prior month, so we are seeing some kind of a decrease in consumer spending, not very strong. Digging deeper, we did see a huge drop-off in online sales, down 6.4% for the month, while physical retailers really picked up the pace there. So we are starting to see people get out of their house, get back into spending at physical retail stores, and that's really helping a lot of those companies. If this month's retail sales report does show another slowdown, so a third consecutive month of slowdown, it could start to worry investors that consumers are starting to pull back in the face of that inflation. I want to look at a few of the stocks that are going to highlight this week. Again, Walmart, ticker WMT, reports earnings on Tuesday. Really going to be the first look into the strength of the consumer. Earnings of $1.48 per share are expected. That is down 12% from the same quarter of last year, even though sales are expected up 0.7% over the period. So investors are really going to be watching for the signs that the company is able to raise those prices faster to cover those costs and how wage increases are hitting the bottom line profitability. Okay, if you do see, whenever you see sales going up or sales flatlining, but you see profits coming down, it's because that inflation, those cost pressures are eating away at the bottom line. So it's definitely something to look to whether Walmart can pass on those costs to customers, turn that sales growth into earnings growth as well. Home Depot also reports earnings on Tuesday, with analysts expecting $3.67 a share. That is also down 5% from last year. The report is going to be important for what management says about the slowdown in the housing market and the outlook for the rest of the year. Again, what we've seen from a lot of companies is they're beating expectations for sales and earnings. Profits are looking good, but they warn on the rest of the year. They lower their outlook for the rest of the year, and that's really hitting the shares. Shares of Home Depot are down 27% from last year's peak, but are still relatively expensive versus its historical valuations, and they are at risk to that lowered 2022 guidance in the earnings report on Tuesday. Target, ticker TGT, also reports earnings on Wednesday for a third view into really the consumer spending for the week. The retailer is expected to report a drop of 17% in earnings to $3.05 shares on flat growth in sales. So again, like what we're expecting from Walmart, except even more so. Target expected to drop earnings by 17%, implying that the inflation and that wage pressure is really hitting the company harder than a lot of others. Company has managed to beat expectations easily over the last 2 quarters, though, so I do expect them to be able to beat those earnings expectations this quarter. It's just by how much, and will they lower their outlook for the rest of the year? Ross Stores, ticker ROST, is one that I've been watching. They're going to report earnings on Thursday, with analysts expecting a 25% drop in earnings to just $1 a share on sales expected to be flat from a year ago quarter. So again, just like what we're seeing sales growth keep up for a lot of these companies, but the inflation, the wages, all of that is eating away at their bottom line. They're not able to pass those costs on to customers. They're eating that, and it's dropping their earnings like a rock. I am watching Ross Stores, though, because this is one of the stocks that held up relatively well in the last recession. Now, we've seen some of the discount retailers, the dollar stores do very well during recessions. As people pull back on their spending, they tend to, the spend down into these discount stores and these discount retailers. Now, Ross Stores is a little bit more of a retailer with apparel and that kind of thing rather than the discount dollar stores like Dollar General, but it still does tend to hold up a little bit better. Deere & Company, ticker DE, reports earnings Friday with expectations for $6.71 a share, an increase of 18% over last year's Q2 earnings, on sales expected that are 19% higher. So this is really the outlier of the group, right? Full year sales and earnings are expected about 20% higher for 2022, and any positive guidance from management could help boost these shares. The fundamentals and the underlying economics for the agricultural space, especially with higher crop prices, is very positive. Shares aren't cheap here, though, at 2.6 times sales, about 40% above the 5-year average. But again, fundamentals in that agricultural sector are very strong. And General Motors, ticker GM, not reporting earnings this week, but got a boost last week on news that Cathie Wood added $6.1 million in shares to her autonomous tech ETF. That's the ticker ARKQ, while selling $12.7 million of her favorite share, Tesla. Now, I'm not suggesting you follow Wood into any of her trades, but it is interesting that this Tesla bull is now admitting that maybe the legacy automakers may have some upside potential in what has been her bull case for Tesla. Okay, ARK is still maintaining its $4,600 price target for shares of Tesla, of which about half of that valuation is based on some kind of a robo-taxi autonomous driving service. But now it's saying that GM may have a chance to succeed in that as well. So they're specifically pointing out GM as a potential competitor in those robo-taxis and investing in that company. So shares of GM obviously trading for a much better valuation, trading for just 0.4 times sales, while Tesla, down 22% over the last month, is still valued at 13.4 times sales. So if you do believe that bull case for Tesla in the robotaxi service, maybe you want to look at GM as well. Make sure you download your free report of the 5 biggest stocks in my own portfolio. Look for that link in the description below, or click on the video to the right for a 12-stock portfolio that will pay you cash dividends every single week. Updating this list, one of the most popular videos on the channel, we updated it with a new list of dividend stocks and even a higher yield. So look for that. Don't forget to join the community by tapping that subscribe button and clicking the bell notification.